let's get rolling. So I had been discussing in the weekend video and also on the Benzinga show. I will post. By the way, if anyone misses this or only catches part of this broadcast, I'm going to post the links to the referenced videos in the description on YouTube, and this video will be up on my YouTube channel probably tonight or tomorrow at the latest. So I see the. I discussed on the Benzinga show and also in my weekend video that the really key levels I see in SPY are that big sort of emotional day that we kind of fell out of bed. And I see the important range for the bulls to gain traction to be over and for the bears to be below. The bears really need to be below 2010-20, which we did close below. I'm going to discuss that in a second. But for the bulls, they really need to get the market back over 212.91, so closer to 213. The way I see it is today was bearish. The last few days have been bearish. We've been selling off, but it's been a very begrudging move. If you see, it's like this. It's like they're trying to force it lower. It's just not kind of going of its own accord. And I think some of the reason for that is that the implied volatility in the market, which is measured by the VIX, got to the lower end of the range, and it sort of doesn't behoove bulls to sell out of the money puts. It also, I think that some prices have gotten a little bit sporty, so to speak. And I think that people are looking to kind of let the market cool off a little. I think there's also the Fed has thrown some of their, has been tinkering a little bit with some of the comments that Janet Yellen's making. I believe she's using a type of moral suasion to try to create an environment where she doesn't have to kind of, quote, force to move on interest rates. Because as we know, the real economy is not doing well. The durable goods orders have been terrible. If there weren't airplanes, it would be negative. That's really been helped by Boeing. The GDP number has been terrible. We are very, very close to slipping back into a recession. We had a negative print. One more of those. 2 back-to-back quarters of negative GDP is technically a recession. None of the economic data has been really good. It's really been very lackluster and has been signaling slowing growth. And the last thing the Fed policy is wanting to do is to raise interest rates into a declining economy. That's how you trigger depressions and recessions. And I think that the mistake that the Fed has been trying to sort of sidestep is the kind of recession inside of a depression, which happened in the 1930s, in the late 30s and 37. And it really only took until after World War II to get them out of the pickle they were in. Obviously, things are very different now. I mean, we do have some, war issues, but it's not like the World War that was back then. And the economy here has changed. We've moved from a manufacturing economy into a service economy. So I don't think we're going to have the manufacturing ability to kind of build our way out of it. I think the sort of the hope has been from central banks that we could kind of muddle our way through it, work off of the excess leverage that had been in the system, and sort of just buy time until things get better. One of the things that has helped the United States that the Europeans don't have, that we have, is our now abundance of natural resources. And I believe that has been able to, the kind of shale boom and the discovery of a lot of new oil technologies, particularly horizontal drilling and stuff, has made the U.S. economy able to kind of muddle through better than the rest of the world. We were the first country to embark on QE. The Europeans, don't forget, had 2 rate increases, which really, I think, did their economy in, and they've been kind of playing catch-up for a while. So this is all like a backdrop to where I want to go with this. So the way I see it, if the Fed is data dependent, if they are true to their word of being data dependent, they've been saying that they expect a 2% inflation rate, and they've been talking about growth targets that we've been nowhere near. They should be doing more QE, frankly. They should not be raising interest rates. And I believe that they are just trying to jawbone and talk the market into a sort of either a correction in into itself, or they're going to be looking just for the market to kind of cool its heels. They don't really want a blow-off scenario like what happened in 1929, or fighting deflation is really their main fear. Fighting inflation is very easy to handle. They're able to raise interest rates. Once you get a negative feedback loop and cycle going, it's very hard to kind of reverse that. So I had written an article and I had discussed that I thought that the Fed was going to be on hold for a while, and I am still thinking that. I know there's a lot of fear around this employment number tomorrow. People are thinking if it's a hot number, the market's going to have to go down. This is nonsense. I don't believe that the Fed is looking at one single number. I do believe that they could trigger an algo squeeze, either up or down, and we will get some movement tomorrow. But the big bad wolf that everyone is so afraid of, believe it or not, is only less than 2 S&P points, which are being factored in according to the options. Granted, we are at the lower end of volatility, so there could be an outsized move. That is something I'm going to discuss in a minute. I'm going to talk about some levels that I see as really important. But the big bad wolf that the media is opining on, I guess they need stuff to talk about every day. Their broadcasts are getting kind of boring, right? There's really not that much to talk about that's relevant. So they are building the fear, so to speak, the wall of worry. I don't necessarily know that that means that we need to go up based on this number tomorrow. I could make the case very easily that we will go lower. And I'm going to give you guys both scenarios, and then I'm going to talk about what I think is the most likely. So today the S&P, I use, those of you who are new to me, I use the retail ETFs because that's what most people trade in. I don't know too many people that are trading in SPX, but I do know a lot of people who trade in SPY. So I usually go by SPY, IWM, and the QQQ, and diamonds, DIA, if I discuss the Dow. But with regard to the S&P, she closed just above the 50-day moving average today, but she also did close below that 210.20 by just a little bit. If we didn't have the employment number tomorrow, I would say that the bias to me would still be down a little bit lower. I don't know that we're going to completely fall out of bed and crash, but I do believe that there is some risk to the downside. If we just simply because of the pattern that I had discussed before, of the look above of range after a consolidation and then a fall back into the middle of that range. And a move to the middle of that range, like I had discussed, would be closer to the 107s, and oddly the 100-day moving average is roughly 108.37. So that's sort of the near-term risk. The 100-day moving average with slight violations have been where I see the risk. So we're kind of moving back to the mid-range, but I see there being some risks between the that 107s area and the 108s area, being the sort of, oddly, if you take a look at the measured move that we're supposed to have based on options, it would take you roughly 2 there. So that is the downside that I see. Today we were forming a bit of poor lows. If you guys follow my stream, you'd see that I often talk about poor highs and poor lows. We had some poor lows on Tuesdays. Those have been repaired. However, we do have some poor lows now from today, and I was really actually hoping that we were going to close on the dead low today so I can go out long. I wound up really not doing very much. As you guys know, I had the surgery, so I haven't really been doing that much the last week. I've just been sort of watching the market. It's just been in this really choppy range. Those of you who know me know I like to trade markets either heavily long or heavily short when they are trending, and we are nowhere trending. For the past 8 months, we've just been in a chop consolidation pattern. And the question now is really going to be, are we going to break out and rise above, or are we going to break down and have more of a severe retracement? And I never like to gamble and guess which. I sort of just go with once I see the action happen. A lot of people always feel like they have to be right immediately and they want to be in before the number. I'm kind of that guy that's like the second mouse, the one who gets the cheese after the first mouse gets its neck cracked when the trap slams on them. So I sort of like to wait for that person to get their neck broken, and then I come in and I take the cheese. So I'm waiting to see sort of how we resolve tomorrow. I think tomorrow would have had the potential, it may still have the potential for a gap up since we had poor lows today, and usually The reaction for poor lows is to have a rally first and then the repair. However, if we do wind up getting a bit of a gap down, I will be looking for that right or right out trade near the 100-day moving average. Tomorrow may be one of those trending type of days. I would be looking for the breadth and the AD lines tomorrow. If they're really firmly planted negative, you want to kind of go with. If they are sort of middling and we get a big gap up or gap down, you may want to play the fade move. Although I tend to think tomorrow may go in the direction of the gap. So that said, that's the downside I discussed with you. So the upside that nobody seems to be discussing now except for me is if we can take out the high of day from today. I think a lot of shorts probably use that today's high of day as their stop out because they would be trailing their stops down. Like if you're long a stock and the stock is moving higher, you trail your stops up. You often hear me talk about trim or trail. So if I were short, and I'm not really heavily of anything in either direction, although truth be told I do have a slight long bias in stocks like Facebook and FireEye and ones I discussed, but I'm not really heavily positioned in either way right now. If I were short, though, I would be pushing lowering my short to today's high of day. So anything above, I think, today's high of day will get a squeeze going, particularly if it's in gap fashion. So if that happens, then I think we're going to go up to retest. We're really not that far from the highs, so I would say the target would be back to the all-time highs and potentially higher to the channel high, wherever that may be. If it were to happen tomorrow, and I'm not anticipating this, we'd be up at like 290, close to 220. The one caveat that I've been discussing, everything though so far has been to plan. You know, we had the look above with the slightly higher high, and now we're falling back to mid-range. The one caveat is that we got the 1.618 Fibonacci extension, and I discussed that in the video, in my weekend video. If you haven't seen that, check it out. And that was roughly about 213.40, and depending on what time frame you were measuring from, either 213.40 or to 214.17, and we roughly got into there, and now we are pulling back. The pullback has been fairly gentle so far, but we are showing that there could be a steeper correction ahead. I think, though, like I said, if we can get above today's high of day and then yesterday's high of day, which was sort of like the first higher high we had been making every day had been lower highs, and then that was sort of like the first higher high. If we can get through that 2-day range, then I think the play is to the upside, and we'll probably have a pretty nice summer rally. And if you miss the first point or two, it's all right because you'll have the next 5, so to speak, or even more going higher. So I'm sort of looking to see how this range resolves itself, maybe tomorrow or sometime early next week. I would say by Tuesday we will definitively know if which way the move is going to be going, and that's sort of how I'm playing it. Let's look at some other indices besides that. Let's look at IWM. That's one thing that has me thinking that the market may still be rather more bullish than bearish, because if you look at the relative strength in IWM, it's sort of much stronger than the rest. Today we did hold above the 50-day again on that. 100-day down there would come down to 222, but I'm thinking anything with IWM, as long as we kind of hold trend, it still stays bullish. If it snaps the trend line, if you just draw from the lows from the 120.24, I believe was the low, if you just kind of connect the lines there, we're roughly holding in an uptrend. We kind of are back, though, like I had said, to be we would mid-range from the upper distribution there. And in my view, if anything gets below, let's say 123.82, that area isn't as arbitrary as it might sound. It was actually the kind of spike low before rallying back up to test the highs within the box, within the last box context. And that is 123.82, like I said. So anything below there to me would get a little bit more iffy. It would also be below both the 50 and the 20-day moving averages and kind of take out a lot of the bodies of the last few days. Okay, so that's one thing that has me thinking maybe a little bit more bullish, meaning the IWM, because that's sort of like been the barometer for risk. The Qs, on the other hand, are looking like they're either looking like they're consolidating up here in a range, or they look like they're very close to a breakdown. Now, the line in the sand, and it will be violated tomorrow if we do have a gap down, in my opinion, is the 109.42. As long as we're above 109.42, I think the Qs are healthy and they're still going higher. I would give that a little bit of give range down to the 50-day, although look, we are so much above the 50-day. Look at the IWM and the SPY. They were significantly. This is significantly higher than those two. Those two were actually tested the 50-day. Today we were nowhere close to that in the Qs. So that also has me thinking maybe a little bit more stability in the market. But I think we could come down and retest that 50. And if we do, what I'll be looking to do tomorrow, if there is a big gap down, is I'll be looking to play some put ratios, meaning buy puts and then sell 2 times the amount out, usually probably in next week's series. And if I'm to do it in SPY, the way I would do it would be to buy the 108s most likely and sell like 105. I'm sorry, 208s, and to sell 2 times the amount of 205s or 204s. Anything I can get on with a $3 or more spread where I can still get a credit, to me would be the right way to do. And then with Qs, I'm already on SPY. With Qs, I'd be looking to probably buy ones close to the 50-day and then sell something between like 106 and 105, maybe 104, depending on how large that move is. And depending on how large the spike is, I'd be looking to catch a couple of bucks with the termination point being down into that support. That, like, those $3 worth of support, there is significant reference levels into there. That's why I think that if we do roll over, it might be a larger move in the beginning, but it'll be begrudging toward the end. Let's talk about some momentum. Apple, for example, did something a little bit naughty today. It closed below the 129.85, which was the Dow Jones Industrial Edition that I had been discussing, and it's sort of just hovering in range, in the upper part of the range. There was a big emotion bar day not so long ago, with 132.91 being the high and the low being 129.12, so I'm not really super duper panicked in that one. The IV in a lot of these stocks has been so low that I've been playing this thing. I've said you've had to play it directionally. I've been in I was in a risk reversal call spread. I took the puts off though because they had gotten so worn down. I had been short the 123s, and now I'm currently with the 22 days to expiration just long the 129, 133 call spread. Not in any significant size, sort of just to be involved in the trade. I am looking to do a roll in that though, because there is a sort of an IV deficiency, so to speak, currently there'll be 35 days to expiration tomorrow, but the 36 days to expiration. So if I could roll that and get that rolled for anywhere between 2 and maybe like 5 cents, I'm looking to do that. I didn't get any fills on that today, but that is something I'm looking to do. I don't mean to skirt the issue too much, but I know a lot of people are sort of, I think the mistake a lot of people make, and the thing I'm seeing on the stream, is that people are always involved in the market every day, trying to play every move, and they're always sort of at max margin in their account. And it's funny, everyone always asks me about, what they think their percentage return should be and how much leverage they should use, and it usually tends to be the max. And that's sort of how you blow up on silly little moves, of just like 3% or so can cause a lot of damage to accounts if you're always at max margin. So I don't really like to trade in and out of season, so to speak. I really like to wait until the sort of the print happens and I get the move that I'm looking for, and particularly when we're like sort of in mid-range, and then I kind of go with it. So, like I said, SPY, I hate to keep harping on SPY, but SPY is really the market. I mean, that is the S&P 500. I believe, like I said, I believe that the risk here, again, for those who came in late here, I believe that the move could be down to the 100-day moving average, and then if we can get above the 2-day high, we will then go higher and for a summer rally. Oil. A lot of people have been curious about oil. I've made some pretty, prescient calls on oil, considering I did nail the bottom. I believe the path of least resistance here, and it's sort of the contrarian view, is higher. I'm looking for oil to get back up to $75, and yeah, that call is made. I believe that it will. I believe it will see there. It's been really, really choppy in this consolidation range, and today's move down for sure didn't help the case. But if there is a move down, we may need to retest the breakout of 54.24 first. And I actually really wouldn't mind seeing that, because I had been long a lot of oil stocks, and I had done it with sort of short put proxies, and they've all sort of expired, worthless, or I've bought them back for like a pittance, and I really wouldn't mind kind of getting back in. I see the risk here being, like I said, higher. I think that tensions in the Middle East aren't going to get easier. I think they're going to get harder. I think that the oil manufacturers are kind of closer to closing and shutting down production. You're also going to have hurricane season at the end of the summer. There's also summer driving season. I think the path of least resistance is higher. Everyone I keep hearing on TV seems to think lower, so being the contrarian in me, I tend to think higher. I just think it's in a bit of a consolidation range here. We'll know on the, I guess, short term, the level here is the 56.51, which was the swing, and then the high here would be the 62.58, which was like the sort of the range high. If we get above there, I'd say the first stop is the 38.2 Fibonacci retracement, which is 67.34, and then the half back is 75.05. That's really what I'm looking for. After we get there, I'll have to reassess the situation, but I believe higher. Were there any other questions? I see there were a few more. FireEye. That was something I had been discussing. I didn't love the price action today. I think the overall market weakness was a little bit too much for it. And the last few days, it's sort of been begrudgingly higher. It sort of is mid-channel here. I would say I'm still a buy the dips on FireEye, but I'm not really like into chasing it here. The way I've been playing it is I'm long a 47.50 call spread. I think it was the 44. It'll be now 43 day to expiry. The IV in it was really low, so I didn't sell any. I didn't sell any puts like I normally would to finance it, because I thought if there was a down move, that those puts would get jacked, and I'd not only be losing on the call spread, but I'd be looking at losses on the put side. So what I'm looking to do is, if there is some type of a rollover in FireEye, and there may be some pullback today. Today's bar was kind of a little bit bearish. We did wind up closing positive, which was good. I thought the news, by the way, was absolutely fantastic. They made for those of you who don't follow the stock, FireEye is one of these cybersecurity stocks. It's really far off of its highs, although it's been consolidating and it's looking like it's trying to break out here. They made a deal with Visa, and they have a deal also with the government, which would limit companies' liabilities if they hire FireEye. I think it caps their liability to like $1 million or something, and FireEye is sort of like the insurance policy. And with all the break-ins that have been happening with like in Target and Home Depot and such, I think that, and now the deal with Visa, I think these are very high-profile things that are going to kind of urge companies to make deals with companies like FireEye. I think that they sort of have the wind at their back in terms of the momentum. So if the stock does wind up pulling back and do something like a retest the breakout point, like, lower into like the high 44s or like 45s, then, you might want to look to sell some out of the money puts. I think that area should hold on some type of a pullback, or if there is a larger market correction. That sounds huge, like a safety net in cybersecurity. Yes, that is exactly what it is. Companies have tremendous liability, particularly, I think, medical records companies. I mean, this is going to be the new big thing, this cybersecurity. I like all of those stocks, really, on pullbacks like that. Palo Alto, the ticker is PANW. That has been a little bit high. It recently got back to the old sort of it's at highs. I mean, I don't really like chasing anything on this tape, but I would say on pullbacks, to like reference levels to like past breakouts or to moving averages, I think you can kind of play by the dips in these stocks. And FireEye, just I had mentioned that I thought that the the thing with CyberArk is it doesn't have a very large float, so that's why I think that, I mean, technically it's a very expensive stock. They all are, based on their earnings, but I think that the bet is that their growth potential is going to be huge, and CyberArk just doesn't have a lot of shares out there. So that's sort of my opinion on it. Someone just asked me about Facebook. My thinking on Facebook, sorry, my allergies are bugging me a little bit. I think Facebook is still bullish. I really liked the price action yesterday. I thought today it kind of probably should have been higher, but I guess being down big in the market held it back. The litmus test for me for Facebook is the 50-day moving average. That's been really key. We're now back above it. Today was day 2 of a close over it. So if you're really like particular about your levels in Facebook, if you're sort of late to the party with the late entry, like if you bought the high yesterday, for example, which I would not be in favor of doing. I always say not to chase. I was telling people that they should kind of BTD down in like the 77, 78, 79 area. Now we're kind of back up into some reference levels, so I would be playing like the trim and trail game, and I actually did. I took off some 4 and 9 DTE short puts, and I'm looking to reload those on weakness. I may actually put on a call. We'll see how things are handled tomorrow. We'll see how the market goes. I may be looking to do a call spread for the upside also, just because the premium in there, the IV again, is cheap, and to play directionally on something I'm bullish on, it's not going to be very expensive if I'm wrong, so to speak. I think that if you're long, the real key area here is that breakout of 81.85 up to a past peak level of 82.17. Today we closed a little bit above that, below that 82.17 at 82.05. I think that there's a lot of pinning risk in this, and I think there's a lot of people who kind of got burnt up here, and there's just some responsive sellers here. So I am looking for higher in Facebook. Everyone knows I'm looking for 100 or higher. I think it's truly the only investable one of the social media networks. I really believe that Zuck kind of stole Instagram, and I think that the valuation of Instagram is going to be shown to be amazing once that Snapchat comes public. I've heard some stuff like that Instagram, if it was to sell today, it could go for even $37 billion. The guy paid $1 billion for it. So I'm really waiting for that Snapchat to come public so people can see the hidden value of Facebook. But I believe that the stock has a lot of runway to go. There's a guy who follows me on the stream, and he had asked me, and I had mentioned this in the video, the weekend video about Facebook, and it was in relation to Google, and it was saying, can Facebook kind of ever catch Google? And my initial thinking was, yeah, that's probably not going to happen. Google is so entrenched and so big, until I started really looking at Facebook's numbers. And I think part of the reason Google has been having so much trouble lately is that their growth is slowing. I mean, in terms of their revenue growth in relation to Facebook. Facebook has been clearly taking share, and they're growing their revenues faster. And I think that some of the money that had been in Google is moving a little bit into Facebook in terms of their advertising dollars. So I believe that Facebook has a lot of runway to go in terms of monetization. They're going to be doing their mobile payments. They're bringing Instagram online now, which is really huge. I had people who, it's funny, I was hanging out with a friend of mine the other night, and she was telling me, oh yeah, I don't really use Facebook, but I love Instagram. I'm like, Instagram is Facebook, and she didn't really know that, but she likes the Instagram, and that I think will be big for monetizing in Facebook. Someone had just asked me about Alibaba. I think Alibaba is it's got a lot of overhead supply, and it's kind of muddling through a funny market. There had been a pullback in the Chinese market, and I think that Alibaba kind of just got caught up in a little bit of that malaise. I would say as long as Baba can hold over that 89.29 breakout high on a closing basis, that it is still kind of healthy. I have a little long in this. I had cashed some of it out a little higher, and now I'm sort of I still have a little bit on. It's really not a big position for me, but I think that Alibaba is going to get up to like that 98 to 100 level to fill the gap completely. They have a lot of shares to bring on in September, and I think they need to figure out how to manipulate the stock higher so that they can unload those shares. So it's sort of, I just think that they're going to have to try to get the stock up higher into that release. I'm not a really huge fan of the company per se or anything that has to do with it. I just sort of think it's a mechanical trade that's what's going to be the case for Alibaba. Is there anything else you guys want to discuss? I saw someone asked about Netflix, and my thinking on Netflix is that it's just been holding high and tight. I don't know when or how this is going to happen, but I think that Netflix is going to. I'm looking for a correction in Netflix. I think it'll probably wind up having another leg higher. It looks like it's holding. If you're long the stock, I mean, stick with it. I would be a little bit more wary if you lost 615 half-ish. There's a little hammer down there. Yeah, in the short term, it looks like it's been holding into that like 615, 16 area. I would be a little bit wary if we lose there. I think the right way to play this would be with, if you want to play, I really would like to see the stock come down. I'm sure a lot of people would. A lot of people who are short are caught in it. It had a huge outsized move, and it's just sort of hanging out up high. So the pattern to me shows if the market stays healthy, the stock will go higher. If the market kind of falters a little bit, we might see a pullback. I'd be interested in really buying the stock somewhere between in the earnings gap candle day range, which was between 530 and 568 half. So somewhere in there, I'd be looking to kind of like buy the dip, so to speak. I think that may get tested a little bit before earnings. Maybe some people will be looking to take some profits before the print. That's just my thinking. I think if you haven't been in the stock, it might be a little bit late to first be piling into it. If you are going to kind of play Netflix, I do believe that their story is good. I like the company. I like their product. The IV is really not very high in the stock, and if you want to do it, just do it with some call spreads. If you want to play short, the same thing. Put spreads, I think, would work out really well. That's my thinking. Buffalo Wild Wings, someone's asking about. On these Q&As, I don't really love talking about the stock so much individually because I can't really show you guys my charts. That's really more for the weekend video. So I'm kind of, I know I did a bunch here, but I kind of want to veer away from it a little bit. My thinking on Buffalo Wild Wings, though, is that it's sort of at some critical levels here. It's sort of near the last gap high of day. I mean, if you're playing the stock, I mean, it looks weak. It may rally up to test the 166-ish area, which was sort of like the gap down high of day. But there's a lower gap here, which is 133. So what I would be looking to do, and I may do this, is I may put on a put ratio, where I'm kind of looking for that move down, but maybe it's not too sudden. They do have earnings they are coming up, so I'd have to cook up a little bit of a trade here with that. But I would do a put ratio, frankly, where with the lower strike being somewhere near that lower gap, just playing for a move down. The IV in Buffalo Wild Wings, the percentage, I mean, it's at a 9% IV percentile. That's what I'm saying with all these stocks. The options are so cheap that you can't really be a put seller or a call seller. You really have to be playing long premium, either directionally, either long or short for these stocks. So that's sort of what I'd be looking to do. One thing about today's close, we were looking at a very underwater close up until like the last few minutes. You can see we really ripped like ripped like 5 points at the end. And then in the last 15 minutes, which with the futures trade, it was like up another 4. So you almost cut the loss in half in like the last few minutes, and you closed just below the opening 15-minute range, which is actually really quite impressive. The low of that was 220.99.75, and the close in the last 15 minutes was oops, I'm cut off here. That's not good. Give me one sec. Yeah, it was like 20.99 quarter. So I mean, it was just below there after a tremendously low day. I think today, to me, really felt like a lot of people who had been very long, who were worried about the number, who were just taking some size off of their positions. It also felt like a lot of people who were kind of like upping their short bets, and it just seemed like a real lack of conviction from the bulls rather than a complete fall apart for tomorrow. I mean, sorry, rather than, like a ton of people playing, just a complete like liquidation for, out of fear for tomorrow. The breadth though was pretty funky today. The NYSE was almost 6-1 negative, it was 5.84 to 1, and the Nasdaq was just shy of 3-1 negative, 2.86. So today was kind of ugly, but it wasn't really fugly, which would have been like 8-1 negative breadth. But today was pretty bad. I mean, if you're going purely on technicals, and if we didn't have the jobs number tomorrow, I would say that the path of least resistance here would be probably there could be a bounce. Like usually there's like a bit of a bounce first because we just hit the 50, but I think that the 100 could be in play. And I'm like I said, on early weakness tomorrow, I'm going to be looking to put on some put spreads. Put ratios if that happens. If we do wind up having the surprise, quote unquote, the surprise, it wouldn't be a surprise to me. If we have a move higher, I'll be looking to kind of play a go with because I know a lot of people are short. We know that because the overnight inventory was all short. We know that we know we sort of had poor lows today. We know that we had sort of the look below here because we're below that candle, and if it rejects, it tells me that there was no more interested new money sellers below that range and that we need to kind of retest. And one of the funny things that has been characteristic about this market is that you have all these multiple days or weeks down, and then you take it all back in like a day or two. And, it's sort of just like it kind of self-corrects itself, like all these liquidation breaks that we have in the market kind of strengthen the market because it takes out some of the weak hand chasers. I would have liked to have seen a little bit of a higher VIX. I think that you start really having to worry about the market with regard to the VIX. We stopped today right at the downtrend line, and we closed below the 200-day moving average. So the real key you want to see with VIX is, you had that gap and go a few days ago. I had discussed that I thought we'd see some higher levels in volatility, but I don't really see kind of like a change in the volatility unless we take out that 1720. If we start taking out 1720, you've taken out the double top sort of spike high before the new lows, and you'd also be making a new high in the leg over 1636. That was the last sort of spike high, and since then we've been making lower highs and lower lows, and that would start changing the pattern. That's what a lot of people always like to be first. They like to be, they kind of want to buy the bottom and then they want to sell the top. That kind of trade to me has always proven very costly because it's very hard to find the bottom and top. I'm not saying that it's not okay to nibble a little bit at some reference levels, either long or to sell a little at some reference levels. But like I said, I like to wait for the trend to develop and show itself before I kind of put on the big bet, so to speak. That's not to say that like if you're at a 61.8 0.8 Fibonacci retracement, there's you can't trade that and kind of do a right or right out trade even in size, but it to kind of say, oh, we're at a market top here, or to say, oh, this and that is at the at a bottom, to me that's just silly, and just wait for the trend to develop. So that's really my thinking. I'm going to be, like I said, tomorrow. Someone was asking me what I'm focusing on. A couple of things that I'm focusing on macro are interest rates, growth in terms of the GDP, and also the dollar. The dollar is really, really key. The reason why the dollar is so important is because companies have been citing it as a problem for their earnings, particularly ones that do a lot of international business. A strong dollar hurts their repatriation. Could you please talk? What is next? I discussed Baba and Apple earlier. If you had missed it, just tune in to the rebroadcast. It's going to be on my YouTube channel shortly, and that YouTube address is Justin Pulitzer Trades. It's in my actually it's in my Twitter profile. You could find the link there, and I would definitely suggest signing up. Oh, okay. Greece. That was one thing I wanted to discuss. So, is Greece really important to the market? It depends on what type of a trader and what time frame you're in. If you're a day trader and you just like bought your stocks, or if you're a swing trader and you just bought them like, let's say, yesterday, yeah, it's probably going to be a problem. If they default, the real fear isn't so much the IMF loans. I think it's more the ECB ones, because that won't go over well with the electorates of those nations. Like Germany in particular. I think that everyone has sort of got a little Greece fatigue. I think it was really ridiculous that they elected the type of government that they did, given the amount of debt they have on, and now they're trying to kind of screw the international community. There's also been a lot of tax cheating over there. It's a mess. I actually lived in Greece for about a year in my college days, and I remember coming back and saying this country is in a lot of trouble, and this is even back when they were on the drachma. And the country, we see clearly what had happened. So I think that a lot of the problems Greece has, believe it or not, is cultural and societal, and it's not going to be able to be fixed so easy. I don't love the idea of this bundling. That seemed to be that sort of was like when the algos kind of took the market out of bed today. Although technically it was just kind of looking for the excuse, and Greece was the excuse. Yeah, I think it's good for maybe a few percentage moot points on the downside, although if we're down big when it happens already, it might sort of be like buy the news, like fear the event, and then like it happened and it's not so bad. Everyone's always afraid of the boogeyman until he comes out of the closet and he's only 4 feet tall, so to speak. So I believe Draghi is on top of that. I think that there'll be a lot of liquidity flooded into the market. They're just getting started with their QE. I think Greece is messy. I don't think it's going to end well. Eventually, there will be some type of problem with Greece. Whether it's this summer or next summer, I'm not sure. I guess one thing that has me a little bit more confident with the markets, and this was very clever, I think, of Janet Yellen, was to get Christine Lagarde, the IMF chief, to come out and say she doesn't think interest rates should go up this year. That gives her a lot of cover to now kind of back away from the sort of rate increase that they've kind of made almost like imminent, right? I mean, like all the Fed talk is like, we're not going to be patient anymore, but that doesn't mean we're not going to, it's just like all this like double talk, shadow boxing BS. And I think the truth is that the economic data isn't good, and I think now that Lagarde, who's buddies with Janet Yellen, came out and said that they think that that rates shouldn't go up. I think that should probably keep the Fed on hold for a while. I haven't been looking for rate hikes this year. If they do a rate hike this year, I think it doesn't make any sense, and I would really question their data dependency. I also don't believe that the economy there's no reason for it. There's no real inflation in terms of what they're looking for. If anything, there's deflation. Anyhow, I think we'll wrap up on that. If you guys have any questions, just hit me up on the stream. My handle is @JustinPulitzer, and I will, like I said, I'll be reposting this onto my YouTube channel. Thanks for tuning in, guys. I appreciate it, and cheers.